You're listening to Market Champions, a podcast on navigating the financial markets. Here's your host, Srivatsan Prakash.
This episode of Market Champions is brought to you by Simplify ETFs. For more information, visit simplify.us. No simplified funds will be discussed during this podcast. Hey guys, welcome back to another episode of Market Champions. I just wanted to remind you to like, subscribe, and leave a comment. Really helps the page grow, really helps the podcast grow. Thank you so much for your support. And now on to the interview.
Hey everyone, welcome back to another episode of Market Champions. Today I've got my friend Tom Roderick, who's a macro portfolio manager at Trium Capital. Tom, thank you so much for being on the podcast. It's wonderful to have you here.
Yeah, I'm very happy to be here. It's been been a long time coming, and yeah, no, it's good to be with you.
Yep, awesome. And so Tom, could you start by telling the audience a little bit about your background? How you got into the industry, and then how you major, and how you ended up at Trium Capital, because you've got a pretty interesting history. Because you did like theoretical physics, and then you moved on to Brevin, and then worked for Hugh Hendry for a bit, and then you're at
sure. So like my background, my path into finance in the hedge fund world is not really a very direct one. I was actually brought up on a small sheep and cattle farm in mid Wales, and so very different from the shining city on the hill that is London and the world of finance. But came here to study physics at Imperial back in the day, and sort of I kind of graduated around the time of the financial crisis, and so very much sort of became interested in that world, and I ended up doing an internship like for an investment bank in 2007. Is my video cut? Oh, for fuck's sake. Okay, apologies. So I worked for an investment bank in the summer of 2007 and saw firsthand the mortgage crisis, because I was working as a quant on the credit derivatives desk, and so very much at the heart of the storm that was about to get unleashed in 2008. And then I ended up working on the graduate scheme at Brevin Howard, which at the time was one of the biggest hedge funds in the UK, if not the world, and kind of spent a few years there before I went to work for Hugh Hendry at Eclectica, and sort of became very much a portfolio manager in my own right under him. And with the closure of Eclectica, basically kind of wanted to work on my own venture, and joined Trium Capital in London to do that, basically.
Got it. And so when did you realize that you sort of wanted to do finance, and especially because your background's in physics, and as much as physics is, I guess, as much as physics is sort of a background for a lot of quants. So, when did you make that shift from just doing physics to finance?
Yeah, so the way that I see it, they're actually not that dissimilar, right? Because you're trying to make sense of an imperfect world, right? And physics is all about that there's kind of like those big picture principles, trying to establish a set of rules on a world which is kind of unknown, and to try and make sense of it as best you can. Now, and I think this is very much the same with the economic world. It's in some ways it's more opaque, it's less explainable, but there are kind of like broad brushstrokes of themes and trends which sort of like go through it. They're like not really rules per se, but like an uncertain set of rules, and a sort of like it's just trying to understand this big system. And so that's what you're trying to do in physics, right? If you're studying quantum mechanics, you're trying to understand the way the world works, even if the building blocks are kind of don't really make a huge amount of sense from an intuitive perspective. And it can be the same in finance, right? You have these rules, which well, not rules, but sort of like themes which come back again and again. You've got technical analysis, which, in some sense, it doesn't really make any sense that a trend, like an upward sloping trend line, would be something that's important for governing the price of, let's say 10-year government bonds, but they do. And you have these kind of like curious links between stuff. And a lot of what you have to do as a macro manager is to kind of keep your mind open and kind of appreciate that you never fully understand what's going on. You're just trying to like understand it as best as you can. You're trying to understand it better than the next guy. And for me, I think maybe because of my physics background and the kind of like the way I look at it in sort of like big system thinking, it's often a lot easier to kind of work out what's going to happen in the long run. Right. But of course, to get to the long run, you need to survive the short run. Sometimes things don't sort of go in a straight line the way that you think they're going to do. You can be entirely right in your thesis, but it can take years to play out, and you can have like vicious counter trend moves against you. So there's two parts, right? There's trying to understand the big picture of what's happening, and there's also making sure that you survive the path to get there. Like both of those, as a macro manager, I would say are equally important. You've got your big thematic views, but you've also got the risk management and trying to understand what's going on in the rest of the market, trying to understand who thinks what and what positions are already in the market.
Yeah.
To try and it's just about survival.
It's similar, yeah, because it's just analyzing systems, right? So yeah. And moving on, so just to get into thinking about markets. So one thing that you've talked a bit about is China, and so let's start there. So a few things that are going on in China right now is one, the Shanghai the lockdown in Shanghai. Then two, broadly speaking, has been an increase in regulation in China when it comes to tech companies, and three has been the Chinese yuan. So let's start off with the lockdown in Shanghai. So how do you think that plays out, and do you think the recent devaluation in the yuan, or the recent depreciation at least in the yuan, has been related to some sort of economic slowdown in China, or do you just think it was supposed to slow?
Yeah, so how the lockdown is going to end, I think, is a really tricky subject, because no one really knows what goes on at the heart of the top level of Chinese decision making. Like, it seems that's even true of like a lot of professional China policy watchers who are based in China. They don't really know what goes on behind the scenes. It's very, very opaque. My guess is that what we've seen time and time again is once they've started with a policy choice, they kind of continue with that until it sort of reaches its natural end. I'm not really sure we've got there yet. I think from the perspective of the CCP, they have pretty much managed to reduce the cases in Shanghai, and so I think as far as they're concerned, their policy has worked. Now, of course, this is not necessarily a good thing. This could just like prolong the crisis in a way, because COVID is not going to go away. It's still rife in the rest of the world. It's going to come into China again, and they're basically going to be forced to do the same thing in city after city. There's no natural immunity even in Shanghai. Like, the number of infections we've got is very, very low. There's no natural immunity. The vaccines aren't that good. And so there's nothing stopping the same thing happening again. Like, you can't close your borders forever, right? But at the same time, you could kind of argue that China was in a particularly weak spot economically before they decided to go into this lockdown. We had a property crisis was sort of coming to a head. You've seen a lot of the listed developers go under. all of which looks very, very bad for the Chinese leadership. But if they can put the economic woes on something else, this bug, this alien invasion that's sort of descended upon them, they're not personally responsible for it. And so, there could be an element of convenience in what they're doing. There's a shortage of goods worldwide. There's not enough oil, there's not enough of a lot of other basic resources. And obviously if parts of China are shut down, they use less of them. And so, maybe part of this is convenience, but either way, given that they've had a perceived victory in Shanghai, and it's a very, very good scapegoat to sort of explain away a weak economy, I don't really see their policy going anywhere. But talking more about the housing situation and China's economy more broadly, my view is very, very pessimistic. You've essentially had, China had one of the greatest demographic dividends in history from sort of the mid 2000s to today. You had a combination of a not very old population from the poverty of the past, coupled with the one-child policy, which meant that you had this vast working age bulge of population, and as a result, China grew very, very strongly, and there was the need and desire to build huge amounts of infrastructure, particularly in housing, to sort of accommodate those people, to accommodate that huge wave of people sort of making their fortunes in the urban cities to the east of China from the West. And what I think a lot of people are failing to consider is that, whilst yes, you can sort of, you can socialize the housing development sector, you can sort of you can solve the problem in terms of the listed equity, but there's a bigger problem here. And that is a problem of that demographic dividend being over. Population growth in China has gone into reverse. The working age population has gone into reverse. And, the key factor for property desire is urban population growth. And, that is still somewhat positive, that is still slightly positive now, meaning that, you do need to deploy some additional investment in property. But it's nothing like it used to be. And so, whereas previously these huge investment cycles in China have essentially been accommodating China's future need for property. You can say, yes, they built it ahead of time. They didn't need all of it right now, but ultimately the argument always was, well, they're going to need it in 10 years time. And so, if your economy is a bit weak, why not just build more now? The problem is that whole argument is gone because population growth is not there. And so, any sort of further investment into property is not investment ahead of time, which might be useful at a later date. It's malinvestment, pure and simple. It's stuff which just doesn't need to be built. And so therein lies the problem that China has right now. Their kind of investment-driven growth model has really come to a natural end. And there doesn't really seem to be any great ideas about what to replace that with. People have been talking about a shift towards consumption, and that would somewhat solve the problem. Right. If you can allow wages to rise within China, and you can allow people to sort of, allow the citizens to capture more of the economics that are currently falling to the state and the sort of the state-owned corporations, you could increase consumption at home, and perhaps that would help. The problem is they don't seem to be able to do that at the same time as, retain this overarching state control. If you keep people poor, there's not, if you keep people poor without too much economic power, without too much political power, it's very convenient. You can kind of perpetuate the state in its current form. China seems to be stuck. It seems to be stuck in this authoritarian, repress people's economic power because you don't want them to have political power. And so it's in a quagmire. If they want to keep that political control, they can't sort of unlock the doors of economic repression on the part of their people. And so there's really no good option.
Right. And so how do you think, so, this has sort of been the argument that Michael Pettis has detailed out so well, is that, as you mentioned, so they have been so focused on the investment function of GDP, that's led to overinvestment and beyond, and a large growth in debt. And then beyond that, Michael Pettis has argued for a shift from focusing on investment to focusing on household consumption. And so, to that end, how do you think sort of the end game for this plays out? Do we end up with a property crash, for example, or is there a possibility that China never reopens, or something crazy like that? So how do you think this ends up playing out?
Well, I think China will reopen. I think the pressure that they're facing from their own citizens to reopen is growing and growing. You're making your people angry. People have, the population of China up to, I would really say this year, has been pretty happy with the improvement in their lives, right? They don't get to vote. They don't necessarily have a direct say in the system. Right. But on a local level, their needs are met. And they feel relatively content. There's the grand bargain in China is, you keep raising my prosperity and I will allow the system to continue. If the system doesn't allow for that continued prosperity, the whole model kind of breaks. Now, of course, we in the West, we have a system which in the short term may be inferior because we have a political process which is very easily captured by bickering and sort of short-term arguments, sort of politicians playing culture games instead of trying to solve real problems. But at the same time, if you have any one political party or any one sort of political ideology which takes things too far, they'll be thrown out. It will be scrapped, and we can start with a new one. It's kind of like it's an anti-fragile system, whereas China has this overarching fragile system of the CCP built on top of everything. And it's very, very difficult to see how you can sort of change that system and change the way of thinking embedded in it without something seriously breaking.
Right. Yeah. And I think the other things, like from a policy standpoint, what we're seeing is, if we just as a general rule, if we assume that, more capitalism and more free markets, free trade, stuff like that is good. We're seeing China do the complete opposite of that. Increasing regulations on tech. And then beyond that, not necessarily allowing free flow of capital into and out of the country. You're seeing a lot of, would you agree that we're seeing a lot of bad policy just come out of China, which pretty much just makes the problem worse?
Yeah, but the problem is that for a long time, this whole investment spending cycle from a top-down state was actually very, very good for China economically. And that rigidity, that sort of like that long-term vision of the system was a good thing. And now it's come to a natural end economically, but politically it's just stuck there. And so there isn't really the choice. I don't think the policy flexibility is really there for anyone to come and change it. If Xi himself sort of recognizes the flaws in the system and wants to shift to be more capitalistic, more open, maybe it can happen. But there seems to be absolutely no signs of that. He seems to regard he seems to see things in a very sort of zero-sum kind of a way, much the same way that Vladimir Putin sees the world. It's like, we only win by you losing. That kind of ideology seems to be very prevalent in authoritarian dictators. And like, it kind of makes sense, right? Because either you hold absolute power or the guy next to you holds absolute power. So, in the political games closest to you, it is a zero-sum game. But the problem is, economically, it's not. And so, you have these entrenched bad policy outcomes. And yes, like, policy is not great. A lot of people sort of look at what's happened with Russia invading Ukraine and sort of see it as a good thing for China. I find that, quite frankly, bizarre. Like, China is, at the moment, quite economically integrated into the rest of the world, far more so than the former Soviet Union was at its peak. And basically Russia is sort of has pushed the West to sort of unite and to sort of go against authoritarian forms of government, and that kind of reverberates quite strongly back onto China, and it makes what they want to do very, very difficult. The West is just going to carry on along this path of deglobalization, kind of ensuring the security of its supply chains and products, away from parts of the world whose thinking don't align with their own. And so, Russia has made a giant mess, which has made life very, very difficult for China. And and it's sort of like, before you sort of, China could, you like the gap, that the two things that China could choose were like relatively close. They could kind of go for a more gradual like realignment with the West, or sort of like gradually move away. But what Russia has done is kind of widened the jaws of that decision. And seemingly it's made them more and more entrenched in their sort of authoritarian top-down led model, because no one in China has the guts or the ability, it seems, to kind of bridge that chasm in terms of like the policy shift that they need to make to kind of reorientate themselves back with Western consumption. And consumption is important. You need, like, someone has to buy your goods. If you look at the heart of every empire there's ever been, it's not been the place where the coal comes out of the ground. It's been the big cities, like, as your mentor Mike Green likes to say, all roads lead to Rome. And China doesn't seem to want to be Rome. It doesn't seem to want to be the center of consumption. It can't do it politically. It seems to be infeasible. And yeah, so they're kind of stuck. And right. So they're basically forced to kind of double down supporting authoritarian Russia in the kind of dumb decision that they made to go to war with Ukraine. And as a result, they can't change their terrible policy.
Yeah. And the other thing when it comes to Russia, Ukraine is that, we've seen a broad rise in the price of both agricultural commodities as well as energy, and both of which are relatively large imports for China. And so you could see that, for example, when it comes to livestock feed, they've basically tried their best to get their hands on all grain that they can, and seeing that grain prices are through the roof. That's another place where China is losing out. But generally speaking, so what people like to argue is that historically, or not historically, but at least post World War II, we've had sort of a bipolar world where we had the Soviet Union and then we've had the US, and then after the collapse of the Soviet Union, we sort of had just the US as a superpower. And so now, in a way, China is trying to take that role of the former Soviet Union as the other pole to the world. And so one thing that they did in the aftermath of Russia, Ukraine, was they got the Saudis to sell oil to them in yuan. And do you think that there's any chance of China just on a broad scale becoming some sort of a superpower? Or and do you think that this trend of China sort of getting their way, so if I remember correctly, there was a China Russia made a deal to trade energy, and I believe it was the digital yuan, if I remember correctly, or something like that. So do you think do you think, just broadly speaking, the yuan as a whole is going to play a big role in global trade and global and in the global economy?
Well, at the moment, to first order, it's pegged to the dollar anyway, right? The moves relative to the dollar are not that big, even in the last kind of month or so. And so, why would you shift to something which is more illiquid, very, very difficult to buy anything with, when you can just use the US dollar? Like, you've got to provide some form of differentiation, right? It's like, yeah, there's just, I don't really see why sort of third-party countries would rather do their trade in yuan. And and if it is pegged to the US dollar, then the question is, does the PBOC control what level it trades at, relative to other non-pegged stuff, or does the Federal Reserve decide where it trades? And at the moment, it's very, very clear that the Federal Reserve decides where that pegged pair trades relative to everything else. And so, US policy dominates. We've seen in COVID times that the Fed were willing to backstop the US dollar in times of crisis. Everyone understands and uses the dollar. There's dollar bills like transacting all around the world. Like, I don't know of any third country which uses yuan bills to pay for anything, and I don't expect them to anytime soon. The thing is, you can't move it around very much. Where do you park your excess yuan? It's all very well to say, okay, we can go back to a barter economy whereby the yuan is the intermediary, but really, you're just trying to get rid of your yuan as soon as possible, right? You're using it as a bridge. Let's say someone wants gold, someone wants oil. You do a swap through the medium of the yuan. That swap being done through the medium of dollars makes very little difference to the price of the dollar. That swap being done in yuan makes very little difference to the price of the yuan or the desire to hold it. Right. What really makes a difference in terms of what currency people want to kind of hold is where you park the excess. To have an investable asset, a safe asset to park your money. And yet, I do agree that the US government has made the US dollar less safe for certain actors who sort of go against it. The sort of the sanctions against Russia. But ultimately, I don't really see, but all they've done really is made the best currency to transact in slightly worse. It's not like something else has become better as a result. The yuan is just as closed as it ever was. But in terms of where the yuan ought to trade, from a pure current account perspective, a lot of people would sort of argue, okay, it should trade higher, right? It should be more valuable relative to the US dollar. But the thing is, I think the real question is, if China opened up its capital account today, because the thing is, the current account is open. You can trade back and forth into China. What's not open is the capital account. And so if you really want to know where the free market value is of the yuan, the way that you find out is by opening the capital account. And if you look at the value of assets priced in yuan versus assets priced in dollars, dollar assets are cheaper right now. You look at the Chinese housing market, it's like 300% of Chinese GDP. Now, after the fall in US stock market, it's by far the biggest asset class in the world. It's also a complete disaster. There's no price discovery at the moment. Volumes of sales of Chinese property have fallen off a cliff. There's still overinvestment. As a Chinese national, you can't get money out of the country right now. It always used to be the one. There was a lot of people would try and buy apartments in Toronto or Auckland or London or wherever it was, or just take cash out to Macau with suitcases. Obviously, none of that can happen at the moment. money in China is stuck in China. I think the desire of the Chinese investor to invest in overseas assets is far higher than the desire of international investors to invest in China, which is already kind of the more open end of the channel. So it's very, very clear to me that, if you just removed all restrictions from the yuan, it would sell off a lot. And that's notwithstanding the fact that China are stuck in this kind of like fragile, unchangeable policy equilibrium, which they can't get out of, and their demographics are sort of going down the pan at the same time. Like, it's, yeah, I just don't see why anyone would want to hold yuan right now.
Got it. Yeah. Moving on, I wanted to start talking about what's going on in the US with regards to rates, inflation, stuff like that. And so now, how are you thinking through what's going on with inflation, transitory versus non-transitory, and how do you what do you think the implications for rates are, in the sense that when does the narrative sort of shift from where at least at the moment seems to be very inflation focused to something focused on demand destruction and a slowdown in growth?
I think, first of all, it's useful to talk about what's actually priced in today, because it's super easy to have an academic discussion about this and to sort of to say, oh, demand destruction is happening, rates are too high, it's all going to change, everyone is expecting inflation forever, actually there's going to be a recession. If you look at what's priced in today, I just got a chart in front of me on my screen. I don't know if we can share it later. But you look, like one year US inflation expectations are 5%. 1 year forward expectations are 3%. And then if you go and look at like all the way out to 5-year inflation expectations, they're at 2.5%. Now 2.5. So basically what's priced in is inflation coming all the way back from the current elevated levels back to normal, actually fairly quickly. If you look at that 5-year inflation versus history, it's pretty low. And so, the long-term inflation expectations are really quite low right now. And so, inflation coming down relatively quickly is actually what's priced in. And so I think people should bear that in mind when they sort of, try and suggest that, there's an opportunity to kind of like go long bonds and to expect inflation to come down. Like, that's already what's priced. And then, if you look at the other, so if you look at the 10-year Treasury yield, it's a nominal yield. It's made up of two components. One is the longer term inflation expectation, and the other bit is the real yield. The amount that you receive in excess of inflation expectations for being in that asset. And so we've looked at the inflation side of the picture, which is coming down very aggressively to below where it was for the average of the last cycle. And then you can look at real rates on top of that. So if you look at if you look at 5-year real rates, they've come up a long way. They've come up from like minus 1.7% to minus 20 basis points. Again, the entire period apart from 2012 and early 2013, after the great financial crisis, 5-year real yields were actually higher than that. Obviously, we know that they've been very, very low recently post-COVID, but they haven't even come back to normal, right? They haven't even come back to normal with inflation expectations aggressively priced for inflation to come down. And so, real yields on a 5-year basis are absolutely not high. You look further out on the curve, you look at the 5-year forward inflation expectations. Those have come up. They've come up from about minus 50 basis points to plus 50 basis points. And, everyone's freaking out. Everyone's saying the economy cannot possibly hack this level of real rates, which, just to reiterate, is based on inflation coming all the way back down to where it was in the previous cycle. 5-year usually sits around 2.5%. And so, policy has tightened a lot, but is still really very loose compared to the last cycle. And that's with the expectation of inflation aggressively coming down. And so, given what's priced in, I know which side of the coin that I would rather be on. I would say, it's too early to go long bonds at this stage. There's always one or two economic indicators which suggest that recession is, just around the corner. I don't really see it. I don't really, from rates and inflation expectations, I would say, if anything, inflation is probably in my guess would be inflation is stickier now than it was pre-COVID. And so inflation expectations 5 years forward should not be 2.5%. They should be 3%. That's not that much higher, right? On top of that, real rates could go higher as well. I could be wrong over the next few months. You could see a swoon in risk assets and the Fed sort of pivoting back towards lightening the pace of rate hikes. You've sort of seen some suggestions that they're going to do half a percent, and then stop. The problem is that the inflation problem still hasn't been solved. And if you look at the balance sheet, from at the end of 2019, the balance sheet was about $5 trillion US. It then shot up in the last couple of years, pardon me, up to $9 trillion. The pace of QT that's been announced so far of quantitative tightening is to reduce that by about $1 trillion a year. That's still, a year from now, that still leaves an enormous amount of liquidity left. So, you've got two things. You've got the price of money and you've got the availability of money. And, what causes real demand destruction is money just not being available, right? Just there is no credit available to you at any price. You cannot roll over your loans even at penal rates. That's what really causes the bust. The price of money, is a much, much slower acting phenomenon. If you can roll over your loans, but, you're paying a bit more than you paid before, okay, from an equity perspective of a company, it's not great. Maybe your share price is too expensive. You need to, your profits are going to come down, but you're still going to survive. You're still fine. And so for me, rates are not that high anyway. If you look at, and so that's the price of money. If you look at the availability of money, starting from the Fed's balance sheet, there's just an insane amount of liquidity there. I would say, people talk about terminal rates, but my question is, where is the terminal balance sheet? Because it sure as hell ain't $8 trillion. It's probably 5 or 6, which means an enormous amount of liquidity needs to come out before we have any hope of addressing inflation. You look at the banking sector. There's no issue, right? There's no drama about banks, not wanting to issue loans. Banks are still seemingly quite active and want to provide capital to people. So both from the private sector and on the public sector, liquidity, the availability of money is there. And so I don't really understand these arguments that, rates are going to peak. It's just not there. It's basically, you're fighting, you're doing a trade which is already priced in. I would rather take the other side, which is that inflation will, quite likely prove to be sticky. the Fed may delay for a bit, but then be forced to pivot back towards more aggressive policy to actually have any chance of controlling inflation.
That's interesting. And so I remember you wrote a piece about how you use the 3Ds framework. And so, could you describe what the 3Ds are and, how they fit within that investing framework?
Yeah, sure. So that I use as a framework to kind of understand how like the longer term inflationary dynamics are changing. And so, you can get inflation through different ways, right? Like, one way which you sort of saw in the 60s was, a large amount of new workers entering the workforce and needing capital to be spent on them. And at the same time, you had, huge fiscal stimulus. And this time we don't, the demographics are not the same. And there's not, there's a lack of workers in China, which means that, we're more likely to have a labor issue at home. But there isn't the same need to employ huge amounts of new people entering the workforce with new capital. What we do need new capital for is something that's different. And this is where my kind of 3D framework comes in. So the 3Ds are decarbonization, deglobalization, and demographics, all three of which I think lead to inflation being higher in the medium term. So to start, if you take decarbonization to start with, like what is the aim? What's the agenda of decarbonization? The agenda of decarbonization is to change where we get our power from, away from fossil fuels and towards renewable energy. And it's to shift away from the internal combustion engine, burning petrol and diesel, to electric vehicles, which tap into the grid. Like succeeding in this kind of decarbonization agenda means that, let's say by 2040, in productivity terms, we have cars which get us from place to place, no cheaper, no quicker. We have energy which is, no better, no cheaper, but the same, just removing carbon dioxide from the equation. And so we have this huge amount of required investment just to get back to the same place in price terms. So, there's a huge amount of capital investment that needs to be made, with no efficiency gains as a result, and basically, we're solving for something which is not priced. If you look at the way that the world worked over the last 15 years, it's about, efficiency. It's about, making products as efficiently as possible, reducing costs, reducing labor costs by using Chinese labor rather than American labor. And it's, if you need to, burn however much energy you need, just do it as long as it's available. It doesn't matter. Decarbonization turns all of that on its head. There is a question mark about, how much we kind of stick behind that theme into bad times. But, right now in Europe, at least, we are, there's a war on Europe's borders. There's a massive shortage of energy, and politicians are basically doubling down on the renewable energy agenda. The reason is partly understandable, is because, the more nuclear, solar, wind you have, the less gas you need to buy from Russia. And so it sort of kind of makes sense, which brings me, which brings me to the second D, which is deglobalization. We've had a period of globalization where everyone has tried to, make supply chains as efficient as possible. Everything has been about just-in-time delivery, not keeping much inventories, having these huge spider-like supply chains going all around the world, using the cheapest labor, the cheapest sources of fuel, the cheapest everything. Like that model has very clearly come a cropper, right? The the fact that we don't have inventory of key goods, the fact that no Western countries are even close to being self-sustainable in terms of a lot of the products that they need, is causing a real problem. You know, that's one of the reasons why we're seeing all of this inflation. So, you know, we need to move away from, you know, just worrying about the price of our goods to worrying about the availability of our goods. And the way that we ensure the availability of our goods is to build more infrastructure and build that infrastructure closer to home. And again, you know, there was a reason why these supply chains spread themselves across the world in the first place. It was because the price was lower. And so now we're basically saying, you know, much like in decarbonization, we're not focusing on price, we're focusing on security of supply. And the fact that Russia has just invaded Ukraine makes it even more necessary to worry about security of supply. And so, you know, these two things combined, you know, require a vast investment spend basically to get back to the same place. You know, if we could sort of remove the reliance on China in our supply chains by 2040, and everything kind of cost the same and was equally productive, we would consider that a win. You know, so again, price is not the goal. And the third D is, I sort of touched upon a bit already, is demographics. There was this big labor arbitrage where Chinese wages were much lower than US wages. There was a huge amount of excess labor capacity in China. And so the labor market became globalized and all of the jobs went to China. And as a result, wages stayed relatively low in the West. There was sort of like, you know, there's a global excess supply of labor. That's not really true anymore. And so, you know, all of these three things together, I think, lead to a higher inflation world. And so, you know, COVID was kind of like the kicker. It was the sort of the invasion which caused the radicalization in policy. But the inflation was coming anyway, as far as I'm concerned. You know, and you can look at this. So if I may start talking about the stock market in sort of combination with all of these factors as well. So if you look, you know, particularly at the US stock market, like I think all of this sort of feeds together quite nicely in this sort of like, you know, this sort of big system thinking that I like. If you look at the period from 2010 to 2020, it was one of the best times to be a listed company in aggregate in history, because, you know, if you look at where all the gains came from, they came from very low investment spending stuff, you know, advertising, social media, very, very high margin businesses, which relative to their market cap required very, very little investment. And at the same time, you know, there was initially like an excess capacity of a lot of different commodities that we had. You know, all of the mines were built out. They were all overbuilt out, right? You know, the last commodity super cycle ended with excess commodity production. And so all of the physical infrastructure that was needed was there. There was no need to spend on physical infrastructure. At the same time, you know, tech companies had sort of come up with these new business models to squeeze consumers of selling them subscriptions rather than high upfront cost products, and of selling them advertising. You know, we're now advertised to the eyeballs. Like, you know, you look at social networks now versus 5 years ago, there's ads everywhere. You look at Google search, you know, half of your screen is ads. It's like the utility of the product is diminishing, and instead we're being served advertising. And at the same time, you sign up to these little subscriptions here and there for like, you know, extra storage capacity, you know, various different streaming platforms, this and that. And you just don't notice all of these subscriptions coming out of your account until you do. And so I think, you know, we're starting to reach a point of saturation of that sort of like low investment subscription / advertising, sort of hidden sort of profits going to large corporates, which led to stocks, you know, being on an absolute tear and you know, being more, on some measures, more highly valued than they'd ever been before in history, because, you know, on an aggregate level, you basically, companies had found out new ways to extract revenue out of people without them noticing. There was very little investment spending needed because we had the excess capacity from the last commodity super cycle. And so, you know, in some ways, in hindsight, it's no surprise that the stock market got as elevated as it was. But of course, you know what I'm going to say, all of this is getting turned on its head. You know, we now have a shortage of commodities. We need to bring all these supply chains and investment processes back to home. We need to decarbonize the economy. All of these things require, at an aggregate level, huge amounts of spending without really much coming back in the way of profits to companies on an aggregate level. You know, yes, if you own a coal mine, or if you're solving problems in the industrial supply chain, you'll make money. But, you know, as a percentage of market cap, very few companies are doing that. You know, most of them are, you know, a lot of it is software or services or kind of like soft style businesses, which don't really have to spend that much money and have been able to kind of saturate your eyeballs and bank accounts with advertising and subscriptions. All of that's coming to an end. All of that is changing. And as a result, I see higher investment spending and stocks entering a bear market. That doesn't mean that the economy is necessarily going to do that badly. You know, there is a need for wage hikes, right? Because we can't, you know, the labor arbitrage gap has been closed. And so the only way to produce stuff is to pay people more money. And, you know, if you pay people more money, that kind of, you know, given like lower earners that money, their money sort of filtrates through the system much quicker. You know, you give someone on the breadline £1,000, they spend it. You give a millionaire £1,000, they probably save it. And so, you know, the velocity of money of higher wages sort of circulates through the economy pretty quickly. And so what I think, you know, we've seen this sort of like, you know, since the 1980s, we've had this massive bond bull market. Since 2010, and, you know, arguably even, you know, since 1990, you've seen this massive elevation of price to earnings multiples in the equity market. You've had very, you know, diminishing investment spending. I think all of these things change. And so what I think happens as a result is that, you know, stocks do worse relative to wages. Stocks do worse relative to GDP. It's almost, you know, I think people who joined the market only recently, you know, which I am as well, but I sort of like, you know, I'm a keen, you know, I like to look at economic history as well. The sort of the expectation is that stocks will always outperform the economy. That doesn't necessarily need to be the case. I think we're going to go through a long period of time where stocks are going to underperform GDP growth. And so, you know, I actually don't, you know, people sort of look at the stock market and they see a huge problem for the economy. I actually think that the economy, you know, we're still going to have cycles. We're still going to have recessionary periods. We're still going to have growth periods. But I think, you know, over each period, the stock market loses pace relative to GDP growth. And so, yeah, so my view is, you know, is not very good for risk assets, in the sense that even if the economy does well, I don't think stocks will do well. If the economy doesn't do well, I think the inflation still stays there and we end up in a stagflationary environment, and stocks probably do even worse, given the starting point. So
bad or worse.
Yeah, so very pessimistic on the stock market, not so pessimistic on the economy. I don't think bonds are the right trade just yet.
Yeah.
I think it's better to be short equities rather than to be long bonds at this stage.
Got it. Yeah. Also, to wrap up the podcast, wanted to ask you, do you have any interesting stories from, you know, working with Hugh Hendry, when you were like Eclectica? This would be a fun one.
Yeah, Hugh's an interesting guy, right? And so, so he kind of came into markets by, similarly unconventional path to me. He's like, came from the mean streets of Glasgow and sort of ended up in finance through those means. And so I think he's not, he doesn't look like a typical finance guy. He doesn't act like a typical finance guy. But actually, I think people look at him and sort of like they see the acid capitalist and they think that there's acid, there's drugs, there's parties. I actually think his drug is macro. His drug is macro and working out. And so he's not as crazy as you may think he is. But that's not to say that there aren't some good stories. So the cast of characters at Eclectica, Hugh's firm was particularly eclectic. We had the guy who used to play in goal for Spurs, Tottenham Hotspurs for the North American audience in soccer, football. We had an advisor who was in his 60s, was about 5 foot tall, and had a giant long white beard, and who was there to sort of like advise on the process. He was kind of like a guru. We all used to call him Gandalf. And Gandalf would sometimes, and Gandalf, it hurt him to stand up. It hurt him to sit down. So he'd often stand up. So, we'd often have marketing meetings, where Hugh was pitching to clients, and there would just be this 5 foot tall, grey-haired, wizened, wizard-like character standing at the back, and Hugh would just introduce him and say, "This is Gandalf," and then not explain who he was or what he was doing there. It was just Gandalf. So there was definitely some curious characters. I like, yeah. And so what else do I have? Another one which stands out is not so much related to markets, but is related to Hugh being an absolute exercise fanatic. So I was staying with him in St. Bart's. We had a bit of a sort of a macro summit, and I discovered that his exercise fad at the time was basically sea wading, which basically involves walking through like 4 or 5 foot high water just off the beach and just wading. You basically, working out every muscle in the body, just kind of like walking back and forth. But because, this was in the heat of the day in the Caribbean, and Hugh was a pasty Scotsman, sun cream washes off in salt water. So he had to cover up entirely from head to toe. So he basically would wear like these waders with like a hat covering his face, almost like a hijab, arms completely covered. And, there was quite a lot of seaweed on this beach as well. And I just remember like I was kind of like chilling out at the beach, and I just saw him like wading through the water, like coming out of the ocean like a swamp man, like completely covered in clothes from head to toe, seaweed like coming off him. It just looked like an absolute mad swamp monster. And so that will always stick in the memory. I think if there's anyone else on that beach, they would have been very, very frightened to see this swamp monster coming out of the sea.
Yeah, that's fantastic. I think that's a great place to stop. Tom, thank you so much for being on the podcast. So I think your Twitter handle is @Tostro, right? TOSTRO.
Yeah, that's right. TOSTRO. Yeah.
Yep. Perfect. Tom, thank you so much for being on. It was awesome having you.
Thanks very much, Sri. Pleasure.